We are continuing that portion, that is provision for tax. See, I had given you the format already, provision for tax, and we worked out one question. In your notebook it is there, but comprehensive questions we didn't work out. That's why I am doing these questions now. With this we will wind up this chapter. Okay. So we will do exercise number 54, page number 5.111. Read the adjustments first. We have like additional information 1, tax paid, and then we have machinery book value 10,000, accumulated depreciation 40, sold for 2,000. That is the additional information. And we know that whenever we have pre-information, you will have to prepare the ledger account. So here we have provision for tax inside notes to accounts. Did you see? Notes to accounts provision for tax 18 and 11,000. Then other than that we have tax paid during the year 16,000. So we will have to do provision for tax account first, just like we did for the previous question. Okay. So this is provision for tax account. This is exercise question number 54. We have to start this with the opening balance, and opening balance we will write on the credit side, like by balance brought down. This is the opening balance. Opening balance means 2013 you have to take, that is 11,000. Immediately after that you must write the closing balance to balance carry down. The closing figure is 18,000. Then we have tax paid, which we will write as to bank. This figure will be deducted from cash generated from operations. So tax paid here is 16,000. The balance we will write as by statement of P&L. This is the provision for tax made. This is the balancing figure. So balancing figure you just compute, that is 23,000. Close the ledger. 34,000, that's the total. Next we have to do machinery account and accumulated depreciation also we have to do. See, for machinery you have two values, then one in the adjustment also, related adjustment is there. Then for accumulated depreciation also we have three values. So we will do ledger accounts for machinery and accumulated depreciation. So we will write the next one. Opening balance must be written on the debit side, and immediately after that you must write the closing balance on the opposite side. But before you write the closing balance on the credit side, you leave three lines always, because closing balance will be the last figure. Before that we have to write some figures, but when you start we are writing opening and closing balances first. So leave space and write. Opening balance always on the debit side for fixed assets account, that you must remember. Whereas for provision it was on the credit. Now the opening balance, the first year figure, that is 2013 figure you have to take. It is 17 lakhs. Immediately after that you write the closing. It's 20 lakhs. Then read the adjustment given there. Machine with a book value of 10,000. Sold for 2,000. before you work out this question, just go through the format of machinery account I have given. We have something like buy bank, that is the sale value we are writing. The sale value here is 2000. So buy bank we can write 2000. Immediately after you record the sale value, you have to see whether it is a profit or a loss on sale. So here, for computing the profit or loss on sale, you compare the book value with the sale value. Here the book value is given 10,000 and the sale value is 2,000. This will result in a loss of 8,000. Understood? Now, you must always compare the book value with the sale value. Understood? Because original cost and book value, there is a difference. Original cost means that is the cost at which we purchased. From that, when we deduct depreciation, what you get is called the book value. Understood? So cost less depreciation, that's what we are getting as book value. So always compare book value with the sale value to know whether it is a profit or a loss on sale. So here we are having a loss, and one more thing, 10,000 is given like book value. Certain questions cost will be given. If cost is given as 10,000, you must first deduct depreciation, then get the book value, then you have to compare. But here directly the book value is given. So book value you can just compare with the sale value, take the difference. Don't go and deduct depreciation from this book value. Book value means already depreciation has been deducted. So you have to just compare these two. The loss will be 8,000 here, we can write buy loss on sale. So once you record buy bank the sale value, then you have to record the loss on sale immediately after that. Next, what we have to record is the depreciation. And since we are maintaining it as accumulated depreciation account, you should specify this as by accumulated depreciation. Okay, by accumulated depreciation, and you will be having a confusion which amount to be recorded. Read the adjustment. Adjustment we have accumulated depreciation of rupees 40,000. That figure we have to record here. That means the depreciation on fixed asset, that is the machinery which we are selling now. Okay. Accumulated depreciation is the depreciation which we are charging on that fixed asset which we are selling. So that accumulated depreciation is what we are writing 40,000, which is given in the adjustment. Then what we have to do is, okay, we started with the opening, then we have to write all these on the credit side. Now you should find the balancing figure. So the balancing figure here is 3,50,000, which we will write as to bank purchase, and this is the balancing figure. Okay. So that amount, the total is 20,50,000. So this is how you have to do the fixed asset account. Next we have to do the accumulated depreciation account. So again the same format, particulars amount, particulars amount. We have to start it with the opening balance. That opening balance will be on the credit side. Buy balance brought down. So accumulated depreciation opening balance is given as 90,000. It is given less 90 because they have written in note to accounts machinery less accumulated depreciation. But when you write, don't write it as negative and all, write it as 90,000. That is the opening value. Then closing balance on the debit side. Leave one line and write. One line is enough. That is 1,40,000. Accumulated depreciation, other term is provision for depreciation. So the opening balance will be always on the credit side. Understood? Next what you have to do is just see this account that we prepared, fixed asset account, machinery account we did know. Yes. So here we have accumulated depreciation 40,000. Now we are doing accumulated depreciation. Take this figure to the opposite side and this will be written as 2 machinery because we are taking it from machinery. So 2 machinery 40,000. Okay. 2 machinery 40,000. Now just find the balancing figure. So that is total is 1,80,000, so 90,000, which we will write as by depreciation. 90,000 by depreciation. Okay. So by depreciation 90,000, this is what we have to add back with that net profit. That is, this is an item which reduces your operating profit. So we will have to add back this 90,000. Understood? This is the depreciation for the current year. Whereas this accumulated depreciation means it is the depreciation charged on this particular machinery. When you add back, what you have to add back is this 90, which includes already this 40. Okay, so what you have to add back is this 90. Now we will start the cash flow statement. Ledger accounts is what you have to do first. Next we can start the cash flow statement. So cash flow statement for the year ended. It is 31st March 2014. The first section, cash flow from operating activities. Below that it is net profit as per statement of P&L. So it's a closing minus opening. You have to take here closing figure is 2,50,000, opening is 1,10,000, so it's 1,40,000, write it in the column. Certain items to be added back. What you have to do first is, if you have prepared ledger accounts, it's better to go through ledger accounts first, then we will refer the balance sheet items. So ledger account, start with that provision for tax account. Inside provision for tax, you are having this tax made and tax paid. Tax made, now we have to add back. So we will add back this provision for tax 23,000. So add provision for tax, this is the current year's provision, 23,000. Then tax paid figure we need not take now, that will be deducted later from cash generated from operations. Go through machinery account. This sale figure we will be recording in investing activity, that is purchase and sale of fixed assets. Purchase figure again will be taken there. Then loss on sale we have to take now, this to be added back because that reduces your profit. Accumulated depreciation I told you already, don't take this figure, you have to take that depreciation 90,000 which we recorded in this account. This depreciation of 90 and that loss we will add back now. So add loss on sale of machinery. Okay, the loss amount, just take it from that ledger account, that loss is 8,000. Then we have depreciation to be added back. Depreciation is 90,000. Okay, now we'll go through the balance sheet items. The balance sheet, we have share capital, all those items will be coming in financing. Reserves and surplus, note number you have to refer, see whether there is reserves, like general reserve, nothing is there. The other fee, that statement of P&L we already took. Then long-term borrowings we have. Okay, long-term borrowings, there is no note number. This figure again will be coming in only in financing activity, only in financing, okay. Long-term borrowings. Then current liabilities, it includes short-term borrowings. Just see the short-term borrowings given there. It is bank overdraft. Bank overdraft, that will come in financing activity. Then, okay, again current liabilities items we will take only for working capital changes. Fixed assets section, tangible assets, refer the working note. We referred machinery account and accumulated depreciation, that we already referred, we recorded the items. Okay, then intangible assets. Yes, intangible assets, did you see the note number? Patents, last year's figure 30. This year it has increased to rupees 50,000. That means 20,000 increased. That means purchase of patents. Purchase of patents, purchase of intangible assets will be recorded only in investing activities. Understood? It will not be shown here. Then if it is the reverse, last year 50, this year it became 30. That means reduction in value of patents or reduction in value of intangible assets, that is called amortization, which we will have to add back if it is decrease. But here it is increase in value, you have to take under investing. Okay, so yes, so we referred all items in the balance sheet, nothing else to be added back. Yes, so now we get operating profit before working capital changes. Okay, it's operating profit before working capital changes. It is 2,61,000. With that we have to add, as usual we have to add decrease in current assets and increase in current liabilities. Immediately after that you leave space and write less. Increase in current assets and decrease in current liability. So we will refer current assets and current liabilities section, but from current liabilities you must always remember to exclude two items, cash credit and bank overdraft. I have given notes in your book, so just go through that. Cash credit and bank overdraft must be excluded because cash credit and bank overdraft will be taken in financing activity. So don't take it here under current liability. Then from current assets you have to exclude cash and cash equivalents. At the same time here we have to exclude current investments also, because cash and cash equivalents include cash in hand, cash at bank, current investments, marketable securities and short-term deposits. So all these five will be included in cash and cash equivalents. So current investments you have to exclude, it is a part of cash and cash equivalents. Understood? So these are the items given. So we will go through the current asset section. Current liabilities we will see first. Short-term borrowings, okay, that we already referred. We have bank overdraft which will come in financing activity only. So trade payables we will see. Last year it was 83, now it became 15. So it is decreased in current liability, that we can write under less item. So it is trade payables, you take the difference. The difference is 68,000 and show it as negative figure. Why? Because this is less section. Then we have the next current liability, short term provision. Again for that not number is there. So not to account show provision for tax opening and closing figure, which we have taken provision for tax for current year already, which we added. Then tax paid we will be deducting later, so don't take it here. So from current liability you have to exclude this provision for tax if you have such an not to account. Such a not to account, if it is given in your question, then that provision for tax must be excluded from current liabilities. Then current assets you just go through. Current investments I told you it's part of cash and cash equivalents, don't take it here. Inventories, just compare the figures 59 and 37. So it is decrease in inventory. So we can write under add, that is inventories. It is 22,000. Then trade receivables we have last year 23, this year 26. So that is increase in current assets. We will write under less, that is trade receivables. So less 3,000. So now what we get will be written as cash generated from operations. Cash generated from operations, it is 2,12,000. Less income tax paid. That means tax paid means what you have written as to bank in your provision for tax account. So what is your to bank in provision for tax account? It is 16,000, which we less now. So finally it's a positive answer. So you can write it as cash flow from operating activities. Cash flow from operating activity is 1,96,000. The second section is cash flow from investing activities. Again, what is the meaning of investing activities? It is purchase and sale of fixed assets and non-current investments. So we have to go through fixed assets and non-current investments given in the question. Fixed assets section, you refer the tangible assets first. We have prepared account for machinery and accumulated depreciation. Immediately you must refer that. Okay, if you have prepared any account, immediately you must go through that. Bank and sale value and purchase value, directly it is there in the ledger, you just have to copy this. So sale value is 2,000, purchases 3,50,000. So purchase 3,50,000. Remember one thing, you must write within brackets because it is cash outflow. Then sale of machinery, it is 2,000, no? Yes, 2,000, which is positive figure, yes. Then you have to see there is one more item, there is intangible assets given. Intangible assets, refer the working note. Last year 30, this year 50, that means increase or purchase. So it is purchase of patents 20,000, which is positive. Sorry, it is going out, no. We are purchasing patents, so it is cash outflow, which is a negative figure, so write it as minus 20. So now it will be a negative figure finally, that is cash used. You have to write, the figure is 3,68,000 minus 3,68,000 cash used in investing activities. Then the third one, cash flow from financing activities. Cash flow from financing activities, that means it affects the share capital and borrowings. So share capital section you refer now, 14 became 15, that means issue of shares for rupees 1 lakh. Usually it will be issue of shares, not redemption. So we are getting the amount, so it is inflow, positive amount. Then reserves and surplus, that we took already, that net profit. Long term borrowings is next what you have to refer. We have borrowed some more amount. It is last year 1,25,000, this year 2 lakh. So 75,000 more we have taken, like bank loan or something. It can be debentures also. So just write long term borrowings. It will be a positive figure because it is inflow for us. So that is 75,000. The inflow amount. Okay. Next what you have to remember is, I had told you before, from current liabilities we excluded bank overdraft. Did you see in that working note, note to accounts, bank overdraft last year 10, this year 12,000, that means 2,000 we have taken like additional loan. So that is bank overdraft 2,000. This is your cash flow from financing activities. It is a positive figure, so it is cash flow from financing activities. So the amount is 1,77,000. Then fourth one, so 3 sections are over. Next we have to, you just add all 3 and then we will see whether it is net increase or net decrease. Here it is a positive figure, it's 5,000 which we are getting. So it is net increase in cash and cash equivalents. That is, net increase is, sorry, it's 5,000, not 3,000, it's 5,000. With that we'll add, that's 5th section, opening cash and cash equivalents. Add opening cash and cash equivalents. So you have to take here cash and cash equivalents value, opening figure 12,000. Then current investments also you have to take, because here current investments separately given. So it is 5 plus 12, it is 17,000 which you have to add. So now the closing cash and cash equivalents will be 22,000, 17 plus 5, that's a final answer. Just check whether it is correct. You can check the answer yourself. See the balance sheet closing value. So this is over. Balance sheet closing value is 8,000 plus 14, that is again 22,000. Answer is correct. This is how you have to check. So with this, cash flow statement is over. First you revise that entire chapter. We finished almost we finished the chapter almost actually, but I wanted you to work out these two questions because that provision for tax, with that we didn't work out any problem, like comprehensive question we didn't do. So I wanted you to do this, that's why I have taken these portions now. So include these also with that portion. With this, portions are over actually. This year's portions are over. Okay, thank you.